All right, thank you everyone for this great opportunity. So when Diana asked me, hey, wait, can you host a panels at the iConnection this year? I said, yes, but I need to decide the topics by myself, if that's okay. He said, sure, fine, no worries. I said, hey, can I just invite the attendees as well by myself? I said, sure, that's totally fine as well. So today that I'm very happy that to be able to get these opportunities to have 3 distinguished guests. Because I think that what really makes everybody awake at night, it is a geopolitical risk. But it is always biased, no matter it's from the RT to the Fox, between CCTVs and the BBCs. So which is why today that we have 3 very distinguished guests that represent the different regions. So first of all, I have David coming from the West as the CIO of Berkeley Endowment. And also, we're able to get Louis coming from Hong Kong to represent the Asia as the CEO of Gavekal. And also, we get the Sheikh, Fahim, is here, and to really represent the Middle East. Because in our world, we don't call the Middle East, we call this Asian West. So we are able to get today between the Asia, the West, and Asia West to really talk about the new regimes we are shifting into today. So let me just directly go to the topics today because I really want to get lots of great thoughts, particularly given what's going on as a result coming from the elections last week. And so, Luis, I will start from you, okay? As you are a specialist, well-respected geopolitical strategist, as everybody who know you guys, Trump's election last week is very critical, okay? How do you think this geopolitical landscape will evolve under the Trump 2.0?
So I think, first of all, I'm delighted and thank you to iConnections for having me. Thanks for hosting this panel. I think, to be honest, it's a very tough question to answer, partly because when you look at the likely Trump admin, the people that are going to be in the cabinet, not a single person was in the cabinet in his first term, which is, kind of unusual. You're going to have, he's coming in with a whole bunch of new people. So that's the first thing. So, depending on who he picks as Treasury Secretary, it looks like he's already picked his Secretary of State. But, it's not obvious which way he's going to go. That's the first point. The second point I'd make, much more important, is that the world has changed dramatically from Trump 1.0. When the world since 2017 has evolved dramatically in many directions, including, I would say, the first direction is that we've learned since 2017 that warfare is now completely different. Having a massive navy no longer allows the US to control the Red Sea because now warfare, and we saw this in Ukraine, and we saw this in Azerbaijan and Armenia, warfare is all about drones. So you can be a bunch, frankly, of herders in Yemen. You have access to drones, and you can block out the Red Sea. That's already a massive shift. I think the world has also changed since 2017 in that the number one economic challenge for any government today suddenly has become inflation, which, remember, back in 2017 did not exist. That was not a problem. If you look at Trump's election, the biggest swing in voters were with voters who were earning less than $50,000 US. There was a 15-point swing in voters earning less than $50,000. That swing, I think, was a direct result of inflation because inflation always hurts the people who earn the least. So in 2017, Trump could come in and threaten tariffs on everybody, threaten follow a massive inflationary fiscal policy, blow out the debt, because there was no inflation. He now comes in, and you could say he could do that again. He can blow out the budget deficit. He can threaten tariffs. He can kick out all the illegal immigrants. But inherently, this is going to relaunch an inflationary problem in the United States. So, the path of policies may not be quite as wide as it was back then. So today, I think everybody is very fearful of a Trump presidency, thinking, it's going to be like Trump 1.0. The reality is, I think the policy path is much narrower.
Great. So, David, along these lines, that also you started in national relations at Johns Hopkins University, although this decades ago, we can tell from your gray hair. And clearly the world is changing, okay? we already moved away from the unipolar world of that. And as a CIO of very respected prestigious university endowment, how does this really impact on your assets allocation from strategic perspective as well as more from a technical perspective?
Yeah, no, that's a big question because I think there's so many different asset classes in the puzzle when you put it together. And like you say, tactical or strategic time horizon matters probably very much to that. The first thing I would say is our strategic asset allocation, and certainly most pools like ours, we have a much longer time horizon than the next 4 years. And so in that sense, the election results, I would say, are not likely to fundamentally shift our strategic emphasis. That said, I think what is more relevant is perhaps the broader conditions that led to those results. And those broader conditions do have economic implications, and in some cases, possibly longer term. So we're thinking about those things probably a little bit more. We're thinking about, in addition, just like the nature, despite the sort of near-term sentiment around what some of the policy might be, what are the more structural conditions that will lead to kind of more fundamentally different sticky policy around economic redistribution. That has to do with the populism and inequality that you're seeing and the sort of difficult economic conditions across many different subsets of populations, certainly in the United States. But whether you're talking about taxes or regulation or subsidies or tariffs, I think all of those things might be structurally longer term on the table. I think also as it relates to the geopolitics, kind of a unipolar to multipolar dynamic where the US influence in the world is, yes, there and relevant, but is there alongside as more of an equal to more voices around the table that are getting increasingly loud. That also has implications as it relates to backdrop. But when we look at actual asset classes and how we might think about that, the United States is at very elevated valuations. There's a lot priced into those equity prices that are probably concerning as it relates to a long-term starting point for asset allocation. There's a lot of vibrancy in Asia and the rest of the world that over the long term we think will lead to great earnings growth for great companies that service that vibrancy. So I think with all the uncertainty, diversification still wins. Having an equity tilt to what you do still wins. Embracing Asian economic vibrancy in various forms still wins. Innovation is alive and well in the United States, and that creates certainly new markets and new business models, which we think continues to win. So continuing to focus on how to express innovation coming out of the US and the rest of the world. And then also, just as it relates to the uncertainty in economic conditions, having corporates that are quite nimble in their ability to pivot into different environments, which means much more efficient on cost structures, which has an implication, private equity and the ability to drive efficiencies much more, I would say, effectively, probably wins. That said, liquidity wins. The ability to play offense into the technical disruptions that come from increasingly sentiment-driven markets, at least over the shorter term. Markets which can be manipulated more than any other time probably in the history of all of us practitioners in the markets. And so just maintaining extra liquidity to really play offense as opposed to protect are some of the things that probably might be worth highlighting.
Yeah, this is very important, by the way, for lots of the audience. I know that we are in a similar role as allocators, right? And so Warren Buffett said that the cash is king. And also this is very, very unique from the Berkeley perspective because as a traditional David Swensen type of US endowment foundation model, they really focus on the illiquidity risk premiums. But that is a good lesson that I think the differentiate factors, what Berkeley has done in the past, really focus on the liquidities of the strategy of the fund as well as for their liabilities of the spending rates every year. So let me turn a little to Fahim. So let me first read his titles, okay? Just like give you some background.
But we have 20 minutes.
Yes.
My name takes about 10.
So he is the executive chairman of the Department of Government Relations, executive council of the Emirate of Sharjah. And I just want to do a quick survey. How much you guys know where's Sharjah?
Anybody know?
Oh, okay. 1, 2, 3, 4, 5. Great. Awesome. For those who do not know, okay, you guys know Abu Dhabi, right? In the UAE. You guys know Dubai very well in the UAE, right? Let's say drive from Abu Dhabi to Dubai and miss the exit. The next exit, that's Emirates Sharjah, okay? So anyway, let's say you are the head of the government relations in Sharjah that are really just like we have lots of like questions impact this over the years from the what we call the petrol state in like the Middle East. And the petrol state capitalism needs more diversifications. Just like David mentioned that our portfolio needs more diversification, but the same as the oil-oriented petrol states like in the Middle East. And some of these countries are already moving away from the soft budget to very hard budget, which they push back a lot of the overcommitment in the past. What's the solutions? And what is the big plans are in place for many of those petrol state capitalism countries, particularly given UAE and Sharjah are really the pioneers and the leadings as they've been starting doing that many decades ago?
Yeah, thanks, Wei. Good morning, everybody. I'd like to do a bit of audience interaction first thing to make sure people are listening. Who knows what the soft and hard budget constraints are? Have you heard those economic terms before? Okay, I'll have to spend about 30 seconds just explaining it. My country, the United Arab Emirates, when it was founded in 1971, invested a lot of its fiscal surpluses into infrastructure, diversifying our economies away from oil. Petrostate capitalism is a term that I use to describe recycling petrodollars into creating new industries. And it's heavily driven by the state. What you're seeing in the Kingdom of Saudi Arabia today, in other parts of the CIS as well, are similar models of economies investing those petrodollars to spur some sort of economic growth. My contention at the start of this year, and for those that ignore all of those titles, I used to be in sovereign wealth for a long time, and I still speak to Wei as a friend about where I think the region is going. Today, what you're seeing is that, quite specifically to David's point, is liquidity wins. Today, we are net capital allocators in the GCC. Because of sovereign wealth, we have a lot of money to deploy. And above and beyond that, we also have a lot of energy. And if you look at a lot of the industries today, and you know where I'm going with this, all of them need a lot of capital, and they need a lot of energy, quite specifically in tech. So I think what you're going to see is the UAE, a very unique position that we are a net capital exporter. We have the opportunity in our economic development cycle to be in a position today to both deploy internationally, east and west, and attract a lot of talent and industry to our part of the world. The Kingdom of Saudi Arabia, I remain firm on my stance that you are still going to see a lot more domestic deployment to build the key infrastructure to be able to do what the UAE is doing in the next 10, 20 years.
Yep. And that's why you guys probably already saw some of the news coming out that the change of the plans and in the kingdoms, etc. But let's move to Asia, which is, I think, that lots of the audience here is really just like interested about and would like to get some sense about. So David, China is a topic we cannot avoid. No matter from the investment opportunity perspective or from the geopolitical risk concerns perspective. And just like about 6-8 years ago that everybody believed that we cannot miss China, similar to 3 or 4 years ago, we cannot have China. China is uninvestable, right? Let's say very long-term investors like you guys, how do you think about or position yourselves or view the values if there's any coming from these regions to play in your roles of your portfolio?
Okay, so this region, of course, much broader than China. And so I would first say, to my point before about engaging or embracing Asian economic vibrancy in the form that it translates to equities and earnings, we think that that's very, very important to our long-term returns and the ability to capitalize on them. So, but that's a regional statement. And then, of course, within that, there's a lot of different countries. There's a lot of different cycles, a lot of different political backdrops. There are maybe shorter-term challenges and headwinds that, despite long-term potential, might have you underweight a region relative to another within Asia while you're sorting through the noise that could result in existential risks. So there's certainly, I guess what I'm saying is we are increasingly valuing the ability in our managers to make relative value assessments across the region to account for some of those things that we would consider short-term and tactical, but yet important, and lean into value, lean away from hard to diligence existential risk, and in that way still be very active in the region, but not have to put all of our eggs in any given country basket. That said, we still think country specialists have a role. Related to China specifically, depending on who you ask in our seat in the United States and depending on the nature of their governance and the true time horizon they have, you get really wide variety of answers, from China's uninvestable to starting to begin the process of leaning back in as it relates to some assessment of stabilization, and everything in between. Most ENFs in the US, going back the last 15 years, actually emphasized private market investing over public. And the illiquidity risk associated with that, people have really repriced. I think there's a lot of discouragement around doing illiquid investing in China because you're taking such duration risk embedded in policy and what the environment politically looks like and geopolitically throughout duration that is so long. And so I think there's definitely a public equity bias. For us, we never left China. We manage the risks that are more existential, the uninvestable or not set of concerns. We manage that through sizing as opposed to in-out. And then we certainly manage that through trying to be thoughtful in the portfolio of companies we put together, being sort of sensitive to those areas that perhaps have less structural headwind. So I don't know if that answers the question, but
it's not easy. I understand. Lots of pressures on you.
I think the biggest challenge, frankly, is one of governance.
Yes.
Very few investment teams that I've found have done the work and have come back and felt that China was uninvestable. A fair number of governance bodies come to that conclusion without the benefit of being on the ground. And I think there's just a fundamental sort of agency issue related to that we have yet to work through fully, especially because there's this perception that it's going to get worse before it gets better.
Yep. Louis, now Diana is back, because when Diana and I met in Abu Dhabi a few months ago, she asked, hey, what do you keep awake at night? They say, it's not China, it's not the US, it's not geopolitical risk, but it's the misperceptions to understand of the geopolitical risk. Because the world is, to David's point, moving more towards a multipolar world, right? I read lots of your research. I'm a big fan of your research as well. What are the misperceptions at this moment?
So I just want to pick up on a couple things before I answer the question, but I think Fahim made a super important point when he said...
I love this two-way conversation. I know we are run over time probably, but I'll cut these questions shorter later.
No, Fahim made a super important point when he said we invest East and we invest West.
Yes.
Because I think Middle Eastern institutions at this point are kind of unique in the world in doing this, because indeed, I think there was a paradigm shift amongst Western institutions, and more to David's point, frankly, when Russia invaded Ukraine. So I saw it in my own firm. We have a research arm, we have a money management arm. We managed around $3.5 billion in China in open-ended funds. And in the 2 months that followed Russia's invasion of Ukraine, we went from $3.5 billion in China to about $500 million in China. We had $3 billion of redemption in 2 months. Very much on the premise that, oh my God, I got locked in my investments in Russia. I can't have that happen to me in China. So I think a lot of the China is uninvestable talk was first and foremost a CYA approach, or cover your ass, of, I lost a lot of money in Russia, I can't afford to have that happen to me again, regardless of what the long-term prospects might be, regardless. Now, granted, at the time, China was also doing itself no favors. You know, it had COVID lockdowns. It still had COVID lockdowns when the whole world had reopened. There was a very limited visibility on what Chinese policy was, on the prospects for a lot of Chinese companies. You'd had the tech crackdown, you'd had the education sector crackdown. So a lot of people threw in the towel. And you're now at a point where China's 3% of the world MSCI. It's 18% of global GDP, but just 3% of world MSCI. So a lot of people are like, yeah, whatever. I can, you know, even if it goes up 100% tomorrow, it's a small part enough of my benchmark. It's like energy stocks at this point. It's, I get more grief if I own them than if I don't, by my board, by outside investors, by whatever. I get more grief if I own it than if I don't. It's just not worth the headache. It's not a big enough part of my benchmark. And so that's where China has drifted to, which I think presents actually a great opportunity set. Because having 18% of the global GDP and 3% of the world MSCI, long term is not, it just doesn't add up. So you know, that, I just wanted to add that and throw that in. And then now I forgot your question.
What are the misperceptions right now?
Oh, yeah,
Sorry?
What are misperceptions?
Oh, well, that's one of them.
Yes.
You know, to me, look, the biggest misperception out there is, on the one hand, you know, the single biggest asset allocation decision, whether you're sitting at ADIA, whether you're sitting at the California Endowment, et cetera, is a pretty simple one, is you've got the US, that's 4% of global population, roughly 22% of global GDP, roughly a third of global profits, and 2/3 of global market cap. Now, you know, that's a discrepancy that I think we really haven't seen since Japan in '89 was 18% of global GDP and 45% of world MSCI. You know, how long, you know, if you think, okay, the US is going to be a third of global profits for as far as the eye can see, do I want 2/3 of my money there? You know, the US valuation is so out of whack relative to everything else in the world. Today in the US, you're paying peak PEs for peak profits at peak time in the cycle. But if you're not there, now you could say, well, you could have said that 3 years ago and that would have been true. And if you have been underweight US in the past 3 years, by now you've lost your job. You've been fired. So it's a very, very, you know, tough discrepancy. But the discrepancy between weight in global indices and you know, importance in the world, for me, that's the biggest anomaly in the world right now.
Yep.
It skews one way for China, and it skews the other way for the US.
Yep, which is why we have the title today for the navigating across regional, right? And also we move to the, what we call the West Asia, which is Middle East, that Fahim and I last met in the regions that you were flying to China in the following days and meeting with the local government officials in Shandong province. I believe many of you guys don't know where it is. And it is a town and a village that have more populations than UAE, right? I was like, wow, you definitely go wild, go to the deep, right? Rather than normal mega cities like the Shanghai, Beijing, Shenzhen, etc. So you are a German Emirati and spend most of your time talking with the British, the Europe, the American audience. Can you give the regional audience today, just like given your background on your global upbringing, and with that, what do you think that Asia is becoming a more important global partner for you guys, and why?
So first I have to explain the German Emirati. My mother is German. So no, I've spent my career explaining the Middle East to a European audience or a Western audience, and then explaining the West to a Middle Eastern audience. The best way to describe what I've done for most of my career. Picking up on what Louis was saying earlier, when, you know, if you look at 1970, India, China, ASEAN was about 10% of the US and Europe in terms of GDP size, right? Today it's about 55%. Like, the trajectory is going in a particular way. And if you think about the role that we play, specifically in the GCC, let's be granular. Like, we love these blanket terms, right? Sovereign wealth funds, the Middle East, Asia. If you actually get granular, the role that we play in the GCC and the global economy is we're reliable energy partners, reliable security partners, and increasingly a core part of, you know, financial and trade supply chains of the world. Capital flows through us, goods flow through us. That's the role that we play. If we talk about, and we use terms like bipolarity, multipolarity. Once again, let's get granular. Let's take politics off of it and focus on what I particularly enjoy, which is geoeconomics. Irrespective of your political leaning, we are in a geoeconomic multipolar world today. That's my contention. There is not one economy in the world that isn't, that controls, the global economy. As much as politicians want to dislocate, supply chains, we were talking about this yesterday, reshore, friendshore, homeshore. Speak to a CEO of a large firm and he will tell you or she will tell you how hard that is to do. So with that, what you need are platforms where you can continue to trade, where you can continue to deploy capital, where you can continue to facilitate trade, investment, and so forth. And that's the role that we play. If the Middle East, and specifically the GCC, did not have a global outlook, east, west, north, south, then we wouldn't be playing our role. So I think what you're going to see more and more over the coming years is firms in the US, firms in China, firms in India, investors in Europe, entrepreneurs in Africa continue to leverage us as a platform to be able to still be part of that global economy.
Yeah. As we are coming to the end of this panel, so I really want to use 1 minute for each of you. So I'm going to ask some questions, not quick, just increase or reduce, or add or reduce, okay? It's really about the challenge and the opportunities, all right? So for example, Dr. Luis, I'm going to ask you, hey, we all think about Trump's deal maker, right? But Trump's his challenge to the regions. What exactly he wants from China?
Yeah, I think that's a great question. I think if you listen in this campaign trail, I think the key desire at this point, not only of Trump, but of US policymakers in general, is to bring industrial jobs back to the US. They want to do that, if you're on a J.D. Vance view, for humanitarian reasons. You could say, the US has 70,000 deaths of opioid a year, deaths of despair, mostly in the Rust Belt and the Appalachia. They need to bring industry back for that reason, but more importantly, they need to do it for geostrategic reasons. I think with the Ukraine war, we realized that, we'd outsourced too much industry. Today, Russia produces 3 times as many artillery shells every month than the whole Western world combined. For every 200 ships that China produces, the US can produce 1. So how can you claim to be the world's military hegemon when you produce less than 4% of the global steel? The answer, and when you're Germany, you can't even produce paper. The answer is you can't claim to be military hegemon. The Western world needs to reindustrialize. So I think what the US wants from China now actually is China to move factories into the US. BYD to open factories, Longhorn Machineries to open factories. And I think a deal might be able to be struck around that.
Great. And David, you mentioned about the challenges, right? Where do you see the opportunities in these regions, right? You came here for a couple of days. Where do you see the opportunities? And what are the structure-wise, strategies-wise you are looking to add to the portfolio?
Yeah, well, so maybe putting aside China, we remain invested in China. We think there's plenty of opportunities given the longer perspective that you take there. But in addition, I think we've talked a little bit about some of the factors that would be driving incremental opportunity in Southeast Asia, incremental opportunity in India. These are things that are resultant of some of this sort of dynamics around reshoring and supply chain redistribution. They're intrinsic to their own economies and their own development paths. I mean, there's so many different sectors that are in very early stages of development and much longer runway in creating ecosystems of companies that service up and down the supply chains to really grow big market spaces in each of those broad regions, India and Southeast Asia. So I think both those places deserve more capital. India is challenging because it's expensive. And it's perennially expensive in its equity market, but it's expensive relative to its own history at this particular point in time. But it is very well positioned against many, many different tailwinds. And I would expect that cyclically, it perhaps is a bit elevated, but we would expect that we'll have capital there for a long time.
Cool. Last questions for you, Fahim. Is that as you mentioned, geo-economy, which is, I believe, UAE or Middle East actually in upper hands in this, no matter the bipolar or unipolar, you move into the multipolar worlds. What is UAE can offer in these cross-regional opportunities you are seeing right now as a platform?
Look, I think here's sort of a word of warning to some parts of the world today, just from my vantage point, speaking to entrepreneurs. So I mentioned earlier we have capital, and David mentioned about businesses being agile and being able to navigate this very, very challenging scenario that we're in, where we're going to see trade wars and so forth going forward. What the UAE has to offer and what entrepreneurs come to me is how quickly they will move. Right? To Louis' point about factories, is the type of talent that we attract, they don't have factories. They need a laptop, they need server space, and they need an office. And with that, our ability, the UAE's ability to issue policy quickly, to cut through bureaucracy, to create an investable environment, means that today I see an increasing number of firms literally packing their bags out of Europe, out of the UK, out of the US, and coming to our part of the world to say, well, I'm in the middle, north, south, east, west. There's capital that's investing in me, lower tax regime, and we can serve the world from there. So once again, I'll maybe leave with that. If you need a reliable partner where you have the ability to play that core part of supply chain and financial infrastructure for the global economy, then that's what the UAE has to offer.
Awesome. Thanks very much.
Thank you, Wei.
We are going to be around a little bit after this panel, so if anybody have any interest to ask any questions, we're happy to answer. Thank you so much for this.
Thank you.
Sheikh.